Hello everyone, welcome to How to Financial, where we discuss all things economics, finance, and personal development. Today, we're going to talk about the different economic classes and how they are defined by different sources. First, let's start with the traditional definition of economic classes. The U.S. Bureau of Labor Statistics, or the BLS, provides data on income levels and earnings for different groups of workers and households. In general, the BLS uses the following income ranges to classify workers and households by earnings level. Low-wage workers earn less than 20th percentile of hourly earnings for all workers. According to the U.S. Census Bureau, in 2020, an estimated 11.7% of the population, or around 34 million people, were living in poverty. For 2021, the poverty threshold for a family of four with two children is an annual income of $25,750. For a family of three, it's $22,000, and for an individual, it is $13,830. It's worth noting that these poverty thresholds are not adjusted for regional differences in cost of living, and are considered to be an approximation of the poverty level. Some experts argue that these thresholds are underestimating the number of people living in poverty, as they do not take into account the real cost of living, especially in high cost of living cities and states. Middle wage workers earn between the 20th and 80th percentiles of hourly earnings for all workers. It's important to note that the concept of middle class is often difficult to define, as it can mean different things to different people, and can vary depending on the context and location. The concept of middle class can be defined in many ways, such as median income, median net worth, or even by lifestyle and consumption habits. Some experts use the term middle class to describe the households with an annual income between $35,000 and $100,000. High-wage workers earn more than the 80th percentile of hourly earnings for all workers. The U.S. government does not have an official income threshold for determining who is considered wealthy in America. There is no agreed-upon definition for what constitutes as wealthy, and the concept of wealth can be defined in many ways, such as net worth, annual income, or even by lifestyle and consumption habits. However, the Internal Revenue Service, or IRS, does have income ranges for determining the top income tax bracket, which is currently 37% for individuals earning over $518,400, and for married couples filing jointly, earning over $622,050. Additionally, the Federal Reserve Board's survey of consumer finances reports that the top 10% of households by net worth had a median net worth of $4.07 million in 2019. Now, let's take a look at a different perspective on economic classes, as defined by Robert Kiyosaki, the author of the Rich Dad Poor Dad series of books. According to Kiyosaki, the main difference between the rich, middle class, and poor is their relationship to money and assets. Kiyosaki defines the poor and the middle class as people who primarily rely on their earned income, from wages and salaries, to make a living. They often live paycheck to paycheck and may have a high level of debt. They tend to invest their money in liabilities, such as consumer goods, cars, and houses, which do not generate income and only depreciate in value. On the other hand, the rich, according to Kiyosaki, primarily rely on their passive income, rental income, dividends, and interest, to make a living. I would put forward a new definition for these economic classes. Poor means living beyond your means, middle class means living at the limit of your means, and wealthy means living below your means. It is important to note that the standards of living where you reside make a huge difference in these definitions. You can make a small income, and as long as you spend far less than you bring in, you could be considered wealthy. In fact, many have recently tried to achieve this level of satisfaction with the tiny house movement in America. While some see it as absurd, these individuals don't let social status define them, and are often closer to financial freedom than those considered wealthy with large mansions and their associated large mortgages. Conversely, you could bring in an enormous income and spend it all on unwise liabilities that exceed your income and therefore could be defined as poor. Nothing is so tragic as the story of a lucky lottery winner who blows all of their winnings and ends up as poor and broke as before they got their lucky jackpot. Usually in life, achieving balance is the goal. But in this financial example, balance would be how you end up considered middle class. An income that allows you to afford a large house in the suburbs with 2 cars, a boat, and extravagant vacations means nothing if you have nothing to save for the future. A large emphasis has been made over the last 100 years to help these folks in the form of self-help gurus and books on how to save for retirement. And a large number of small investment vehicles have been put into place for them, such as pensions, 401ks and 403bs, IRAs and Roth IRAs, 529 college savings plans, Social Security, and while I applaud the efforts as a necessary step to financial freedom, most middle-class citizens will continue to spend as much as they make and continue to live from paycheck to paycheck, right on into retirement, until their untimely demise. An unforeseen illness or other such life-altering circumstance is often enough to derail the average middle-class person's dreams of financial freedom. For more information on how to achieve financial freedom, watch my upcoming videos on escaping the rat race. Thanks for watching, and don't forget to subscribe and comment below. If you find these videos helpful enough to watch again later as review, like this video with a big thumbs up.